Aloha and welcome back. Today we're talking about Chapter 7, and Chapter 7 discusses, for a merchandising concern, inventories and costs of goods sold. I'd like to make a comment about this chapter. I think typically for many students this is probably one of the more difficult chapters to understand in Accounting 201. And so with that said, let's talk a little bit about inventory and cost of goods sold. I think the chapter does a great job of discussing the concepts, and I think you need to take your time in reading through it. I think many students find it very helpful to read through the material a couple of times. I think it helps a lot. It can get kind of confusing. Anyway, if you take a look at page 311, Exhibit 7.1 and Exhibit 7.2. In Exhibit 7.1, there's a diagram of a partial balance sheet, and what's highlighted there under current assets is the asset inventory. And so I think I mentioned this when we talked about Chapter 6. For a merchandising operation, inventory is typically one of the biggest and certainly probably the most important or one of the most important asset accounts on the balance sheet. Right below it, Exhibit 7.2 is a partial income statement, and what's highlighted there is the account costs of goods sold. And again, for a merchandising operation, cost of goods sold is typically probably for most merchandisers the biggest single expense account that shows up on the income statement. And those two accounts fit together, and I think when we talk about Chapter 7, we'll see how that works out. If you turn the page and take a look at page 312, Exhibit 7.3, there's an excellent diagram there that shows what's called the relationship between inventory and cost of goods sold. So with that as a reference point, I want to put a formula up here for your consideration. When we are working with inventory and cost of goods sold, we always start out with beginning inventory. The beginning inventory is, let's say we're working with a calendar year, January 1 through December 31. Our beginning inventory is our inventory that was on hand at December 31 of the previous year. This will become the beginning inventory as of January 1 of our current year. Now, as we move through the year, we will buy inventory. For a merchandiser, your main focus of your operation is to purchase inventory, purchase finished goods from your suppliers and vendors, generally to bring them to your place of business, and then to sell them to your customers. So buying and selling is the main focus for a merchandiser typically throughout the whole year. So one of the main transactions that we work with for a merchandising concern is a purchase of inventory. And that item shows up in that Exhibit 7.3. Now, we may have other types of related transactions which don't show up in that exhibit, but I'm going to show them here. If you recall the discussion on merchandising from chapter 6, we had our revenue accounts, we had our sales account, and we had two contra revenue accounts, and those were sales returns and allowances and sales discounts. Now when we're making a sale, we're selling to our customers. If for any reason a customer wants to return an item that we had sold to that customer, then, and as long as we're agreeable with it, then we will record that transaction as a sale return. Or if it's a price concession, let's say we sold an item for $10 and for one reason or another we decide to give the customer a change of price. Let's say we're going to reduce the price by $3, then that would also be considered a sales allowance. So we would use that contra revenue account, sales, returns, and allowances for those types of transactions. When our customers, if we are selling on credit and we are offering our customers terms, including sales discount or a cash discount for early payment, then the reduced amount attributable to the sales discount would be recorded in the contra revenue account sales discounts. Now, just as we have those types of transactions with our customers, we may also have the same types of transactions with our suppliers and vendors. So when we purchase inventory, we may from time to time find that we need to return inventory items that we had purchased. And so those transactions would be recorded as in the account purchase returns and allowances. Purchase returns and allowances is a contra expense account. Remember, an expense account carries a debit balance, and so when we're working with purchases, we're working with debits. If we record a transaction as a purchase return and or allowance, then that transaction would basically be recorded as a credit. Purchase return and allowance is a credit account. Just as we may be offering our customers the opportunity to take cash discounts for early payment, our vendors and suppliers may also be offering us cash discounts as an incentive to pay them early. And so for those types of transactions, we would have an account called purchase discounts. Purchase discounts as well as purchase returns and allowances are both contra expense accounts. The last type of transaction that we would typically see on a regular basis in a merchandising concern would be for what we call freight in, or the cost of freight to get merchandise that we are purchasing to our place of business. So again, we start out with our beginning inventory, which was our ending inventory from the end of the previous year. And then during the year, we have several different types of transactions focused on our purchase of additional merchandise inventory. Again, purchases, which would be the main type of transaction. From time to time, we may have purchase returns and or allowances. We may also be taking advantage of purchase discounts with our suppliers and vendors. And generally, especially if we're in a place like Hawaii, where we're in the middle of the ocean, generally we're going to have substantial freight charges that we are paying to get our merchandise to our place of business. And so typically we call that account freight in. We would group these 4 accounts and refer to them collectively as net purchases. Net purchases. Purchases net of returns and allowances and discounts plus freight in. And so on page 312, Exhibit 7.3, that purchases amount would really be our net purchases. Now if we add this up, if we took a total of what we started out the year with plus what we purchased during the year, that would give us a total that we would refer to as goods available for sale. That would be the total cost of all of our beginning inventory plus everything that we purchased during the year that we could have sold. Now, I always ask this question in class, and I'll pose it here. What could have happened to everything that we had during the year that we had available to be sold? Well, there's really only one of 2 things that could have happened to it. And that is either we sold it or we did not. And so those 2 options are at the bottom of Exhibit 7.3. Either if we sold, if we did not sell, whatever, let me restate that. Of everything that we had available to be sold during the year, if we were to take an inventory at the end of the year, take a physical inventory, that would provide us with a total of what we did not sell during the year. And so that would be our ending inventory. And again, our ending inventory is typically calculated by actual physical count. Many businesses actually close the business down for a day or 2 at the end of their fiscal year to do a physical inventory. It can be a really big job, very time consuming, and it's a very important job. But anyway, if we were to get our physical inventory at the end of the year and calculate the dollar amount of our ending inventory, this amount would represent all of the goods available, all of the goods that were available for sale that we did not sell during the year. And so if we subtracted this number from the one above it, then what we would end up with is the total cost of goods that we did sell during the year. And so let me try and put some numbers to this. There's not too much room over on the right side. Let's say we started out the year with beginning inventory of 100. And let's say our net purchases during the year was 2,000. That would mean that what we had available for sale during the year would be, I'll squeeze this in here, 2,100. And then at the end of the year, December 31, we did a physical inventory, and let's say we ended up with ending inventory of 1,000. We would subtract that amount out, and that would tell us then that the cost of our inventory that we sold was $1,100. The cost of our inventory that was not sold, our ending inventory, was $1,000. And the total of what we sold plus what we did not sell must always equal the cost of goods that was available for sale. So cost of goods available for sale is always a constant. I hope this makes sense. Think about this for a little while, and we'll go on to the next lesson. Thank you.